You are watching the stock market do something historically dangerous. The S&P 500 and the Nasdaq are hitting all-time highs, powered mostly by AI-heavy megacaps, like NVIDIA alone pushing toward a $5 trillion valuation. But underneath that perfect headline, the foundation is cracking. In the real economy, U.S. household debt has surged to a record $18.6 trillion. Auto repossessions are surging at a pace on par with the Great Recession. And the people driving those stock gains are quietly cutting nearly 1 million jobs this year. This isn't just a divergence. This is a paradox that has played out almost exactly before every major crash, 2000, 2008, and early 2020. How long can Wall Street keep celebrating an economy that Main Street can no longer afford? The answer is, until three distinct red flags, which are all flashing right now, finally converge. The setup we are witnessing has been called the Dangerous Divergence by macro experts. It is a market where optimism is concentrated in a few megacaps, while the broader economy, the consumer, credit system, and corporate fundamentals show classic historical signs of stress. In 2008, markets ignored exploding subprime delinquencies. In 2000, they ignored slowing corporate earnings. In each case, three warning signs aligned before the collapse. Today, they are aligning again. Extreme overvaluation and concentration risk, the consumer debt explosion, corporate earnings weakness, and layoff shockwaves. When these three forces collide, the market doesn't correct slowly, it snaps. Red flag 1, the illusion of perfection. The first red flag is staring everyone in the face. Extreme overvaluation and concentration. The S&P 500 is trading at a forward PE ratio of roughly 22.9x. Well above the long-term historical average of around 16.7x. But that number hides even a greater risk, concentration risk. The top 10 companies, led by NVIDIA, Microsoft, and Apple, now control a historic 42% of the S&P 500's total market value, shattering the dot-com bubble peak of 29%. NVIDIA, Apple, and Microsoft alone account for nearly a quarter of the entire market. This is the very definition of a narrow rally, when the market's fortunes depend on just 10 names. If just one or two of those mega caps stumble, an earnings miss, a slowdown in chip demand, the ripple effect could erase trillions overnight. And what is fueling this valuation? The narrative. We are in an AI hype cycle. Companies are openly linking job cuts to AI efficiency to boost stock prices, and a massive $38.1 billion was poured into AI-themed funds by early 2025. The risk here is simple. Elevated valuations leave zero margin for error. If future growth disappoints, high PE stocks suffer more. Red flag 2, the consumer crack. The second red flag is about Main Street, not Wall Street. The foundation of the U.S. economy is the consumer, and the U.S. consumer is cracking. Total household debt hit a record $18.59 trillion in the third quarter of 2025. More alarmingly, the money borrowed is becoming impossible to pay back. Serious delinquencies are rising across nearly every debt category. Credit card debt, 7.1% seriously delinquent, near 2011 levels. Auto loans, 3.0% serious delinquency, highest in 15 years. Student loan distress, 14.3%, the highest on record. Experts warn that this combination could significantly slow consumer spending. Credit card APRs above 22% means the cost of servicing debt is rising faster than incomes. This consumer credit stress, especially among younger Americans and subprime borrowers, has historically preceded broader economic pain and stock market corrections. It's the consumer side of the divergence. The money driving the stock market is running out of money in the bank. Red flag 3, the quiet retreat of corporate America. We link the first two flags to the third, the layoff shockwaves and weak earnings guidance. Companies across multiple sectors, tech, finance, manufacturing, retail, have been cutting staff aggressively in 2025. Amazon, 14,000. Microsoft, 9,000. Intel, 20 to 25% workforce cuts. UPS, tens of thousands. Salesforce, 4,000. Google and major banks, ongoing reductions. Many firms are openly linking these job cuts to AI efficiency and automation. Economists call this a jobless boom. Corporate profits are soaring, yet nearly 1 million jobs have been cut this year, the most since the pandemic crash. This wave of layoffs creates a dangerous feedback loop. Layoffs, lower household spending, weaker demand, weaker earnings, more layoffs. The market is celebrating the AI dream, but the CEOs are preparing for the economic reality. A financial crisis is rarely caused by one problem. It happens when multiple pressure points hit at the same time. This is the domino effect. The AI euphoria made the market top-heavy and reliant on perfection. The consumer debt crisis ensures that a spending slowdown will hit hard. The layoff shockwaves translate that slowdown straight into a corporate earnings collapse. But the true accelerant is sentiment. History shows that markets often look calm and unstoppable right before they snap. Investor psychology in 2024-2025 has regularly flirted with extreme greed. When this optimism breaks, triggered by one bad earnings miss, one geopolitical shock, or one weak macro print, volatility returns instantly. Fear spreads fast. When the first domino falls, confidence snaps into denial and then into full-blown panic. That panic turns a correction into a crash. No one can perfectly time a market crash, but markets do not crash out of nowhere. They crash when the warning signs converge. The historical pattern is clear. Valuations are stretched, consumers are strained, earnings are fragile. That convergence, high optimism meeting core economic fragility, has preceded every major market reversal of the last 25 years. So the takeaway isn't to panic, but to recognize the risk. Stop listening to the headline indices and start tracking the data that matters: credit card delinquencies, mass layoff trackers, and the performance of the equal weight index. Because the next crash won't be a surprise, the warning signs are already flashing in red.